Wealth Week. Tonight, you are going to be hearing from Courtney. Courtney is of the Ivy Investor. The Ivy Investor is a resource for women seeking to navigate the maze of the investment world in ways that make sense. Now, men, don't hop off the line because tonight is going to be for you too. Courtney is a current attorney and former stockbroker and investment advisor. She has 15 years of experience in the financial services industry. She has an engaging and unique style that breaks down the stock market, retirement, and college savings in a way that everyone can just run out and take action. So we are excited to have Courtney with us tonight. Many of you mentioned when you were asked last week, why do you want to invest? Many of the things that I just talked about, retirement, college, family, future, all of that was on your list. So we are excited to hear from Courtney this evening. And I'm not going to take up any more of her time. I'm going to pass it on over to her. Courtney, welcome. And we look forward to hearing from you.
All right. So I'm so glad to be here. I hope everybody can hear me. We are having the conversation about how there's levels to this, how it's important to build out your investment portfolio. So we're going to talk about goal setting and kind of what that looks like, because at the end of the day, and I make a lot of references to food because I'm a foodie. But, my grandmother's peach cobbler is not going to be like your grandmother's peach cobbler, but it doesn't make it any less delicious. So I think it's the same thing about investing, is that we have to do what's comfortable for us based on our goals and what we're looking for. And then kind of from there, we kind of, this works for you. So let's get started. So again, my name is Courtney Richardson. I'm the founder of the Ivy Investor. I've been teaching how to understand and invest in the stock market since 2014. I'm a former assistant vice president and one of the top brokerage firms in the world. I was named as one of 7 Black millennial financial experts to follow in 2019 by Black Enterprise, named one of 9 best financial planners of color by Black Wallet. I've been featured in AARP, New York Mag, Black Enterprise, Forbes, AOL, The Huffington Post, and more. And currently I'm a licensed attorney. I focus on tax, real estate, and estate planning. So that's kind of like all of me, but more specifically, it's about you tonight. So let's have that conversation. So before we get started, I always want to define our terms, but before we also get started, I want to give you guys just a little disclaimer that anything that we talk about in terms of companies or investments is not a endorsement or a solicitation or offer to buy. It's just letting you know kind of as an example or informational purpose. So let's define our terms. So I think the biggest thing is when we talk about investments, when we talk about portfolios, we talk about asset allocation, they seem like really big words, but I really want to kind of break them down to what they really mean. So a portfolio is just a collection of all your investments. So collection of all your stuff. Think of it that way. So, okay, so you have a bank account. You have some stocks or bonds or mutual funds in your 401k. You may have an account on the side that's not related to retirement. So all of those things together are considered your portfolio. Okay, so it's just a collection of all your stuff. So your asset allocation is the mix of all of your stuff. So the mix of your investments again among different asset classes. So I have somebody mixing up some cake because, like I told you, I'm a foodie, but it kind of just gives you an idea. So we have our eggs, we have our flour, this is a pineapple upside down cake, our recipe of mango upside down cake. So we have our mangoes, we have, our milk, we have all of those things with the butter, we have all those things put together, but it creates kind of your investment portfolio. But the asset allocation is all those different ingredients along the way. So when I talk about asset classes, I really want to talk about that because it's something that we kind of talk in passing. A lot of people are like, not really sure what that is. So your asset classes, I kind of talked about it already. We have some cash, we have fixed income, which we know as bonds. So a lot of people don't know bonds normally. Like they're like, oh, what's a bond? I'm pretty sure most of us have had experience with fixed income in our lives. How? Because of savings bonds. Government savings bonds are considered fixed income. because you're getting a regular rate of return or a regular amount of money returned to you on a regular basis until, the time is up or it's over. So that's kind of your fixed income. But also, generally, when you have fixed income or bonds, it's actually the company or government owes you money. So you lend them money, and then kind of just normally when somebody lends money, there's interest attached. So that's what that fixed income. So there's a fixed income payment, fixed payment or fixed interest payment that we're receiving like twice a year, once a year, however. But then at the end, what happens? They got to give you the money back. So that's kind of your fixed income. So a lot of people like them, especially for retirement, in terms of bonds, because they know that they're going to get a regular payment every single month or every single quarter or however it's set up. Equities. So equities are just stocks. So equities is ownership. So we have fixed income where someone owes you money, and then equities or stocks when you actually own a piece of company or you have ownership. And then we have commodities. Commodities are like pork bellies. They're kind of all the fun things that are out there, oil and gas. Real estate is considered an asset class, and you have alternative investments. So cryptocurrency is considered a alternative investment, just as an example. So your portfolio and your asset allocation, this is kind of when we're going to start getting into the fun of it. It depends on your portfolio, what you have, and how you have your stuff allocated. So your stuff and how it's kind of mixed up in terms of your asset allocation depends on your goals, it depends on your risk capacity, and it depends on your risk tolerance or your emotion. So we're going to talk about goals, we're going to talk about risk capacity, and we're going to talk about risk tolerance. So when we're talking about risk, so I kind of gave you guys like a little kind of hierarchy of kind of in terms of risk, like where is everything? So with your bottom part of risk, you have your bank savings account. And this is where people kind of talk about the greater the risk, the greater return. That doesn't mean that we're crazy with it, but it's just the understanding that if I have money in the bank, it's liquid, means I can touch it at any time. I can just call up the bank or move it or go online and move it, or whatever we're doing in COVID. Normally we just go into the bank, but sometimes, you can't do that, or you're going online. Your bank savings account is liquid, but so you're not really getting that much interest. You're kind of like, okay, I saw it yesterday. I was like, oh, 5 cents this month. That's wonderful. So you're not really getting the return, but you also have the safety. So then you have your bonds, which are a little bit more risky. And then you have your index funds or ETFs, which we'll talk about a little bit later. And then you have your individual stocks. So you have bonds when someone owes you money. So the risk with bonds is that somebody may, go out of business. We hope the government doesn't go out of business, but a company can go out of business. Or even some governments. I think the city of Pittsburgh was junk bond status like in the early 2000s. So in Pittsburgh, Pennsylvania. So I share that with you, saying, okay, so junk bonds mean that you have problems paying your bills. But for the most part, bonds are a little bit more less risky than an index fund or ETF, which is a basket of stocks. And then you have your individual stock. And then you have your alternative strategies, was I stuck up at the top because it's something that's a little bit more, it's very risky, especially if you don't know what you're doing. So we'll talk about that in a second. So when we talk about risk capacity is the maximum risk that you can take based on your circumstances, your goals, your current finances. It's based on facts. So if I have, $100, me putting $100 in the stock market doesn't really make that much sense because I don't have anything else left. If something happens with my money or I can't get to it, it usually takes about 2 days to get money out of the stock market. So that's kind of one of the things that's based on facts, based on what I have in my pocket. And then the risk tolerance is kind of like my emotions. It's like, what's my ability to tolerate swings in the market? I had a lot of friends today reach out to me and are like, Courtney, and yesterday, like, oh my gosh, my account. And I'm just like, they're like, I should just leave. And I was like, why? Why are we doing that? You have a long time to retirement, you have a long time to your goals, but there is kind of like emotionally, they're like, oh, I can't take that jumping up and down. Oh, I can't take that. So that's what that risk tolerance is. So we have to manage our emotions based on the facts that are in front of us. And then some people also will be really, really risky. Like they'll put everything they have in cryptocurrency, which is fine, but they may not have anything else for a rainy day, emergency fund, anything else. So again, we're kind of on both sides of the fence. It's like on one side, it's like, oh, I want to take my money out when I have it under my mattress. And then I want to put everything I own in like pork bellies and cryptocurrency. And it's like either one really doesn't make sense. So you want to have a balance. So, in terms of having goals for investing, you want to have SMART goals. So, specific, measurable, attainable, relevant, and time based. So, for example, if someone says, so my mom came to me, my mom in 2005, she came to me and says she was bankrupt. She filed for Chapter 13 and she was just finishing up her bankruptcy. And she says, I can't do this anymore. I need to retire in 10 years. So I ran all the numbers. I looked at her risk capacity. I looked at, her current circumstances, and I looked at her income, and I was like, and I looked at her social security numbers, and I was like, I can't do 65, but I can do 66. Can you give me one more year and we'll make it work? And she said, yes. So that's what we did with my mom's account. So what I did is I invested her in her 401k, which we'll talk about how the 401k works and why we like it. But on top of investing her in a 401k, we were actually able to kind of have a diversification of her portfolio to make sure that, what her goal, everything matched her goals, what her account composition, her portfolio matched, her asset allocation matched her goals. So we want everything to kind of be in alignment. So if you're saying, hey, I want to retire in 20 years. So we're going to be, you want to be aggressive, but you want to be mindful that you have a 20-year time horizon, what that means is that, we don't necessarily, we want to be aggressive, but we won't want to be too aggressive. So if you're retiring in 20 years, so we'll say you're like in your mid 40s, which is great. You're going to be a lot less, aggressive or kind of risky than somebody who's in their 20s who has 40 years to retire. So I just put that in perspective in terms of goals. So you want to be specific, saying, okay, I'm looking to retire in XYZ amount of time. And, you want to be able to measure it. So every single year you're saying, I want to retire with $1 million, in my retirement account. Okay. So that means that you're going to have to do something like, and I'm just giving you numbers. So you will have to do, if you're retiring in 20 years, you're doing 50,000 a year. So how do you get there? Can you get there? Is that reasonable? Is that attainable? And it's relevant. Well, your retirement goals, saving for retirement, your retirement goals are relevant. And then they're time-based. You said, hey, I want to do it in 20 years. So again, we're putting ourselves in a position where we're actually kind of making sure that everything is working together. So here's the thing about what I think about retirement, and we're going to start to have the bigger conversation, is that retirement money, you're reducing your taxes now, typically, if you're doing a traditional account. And then you also reducing, and I say this kind of tongue in cheek, but you're reducing the likelihood of being broke in retirement. So if you're putting money away now, you're kind of helping yourselves with reducing your taxes, but then also you're reducing the likelihood that you're not going to have enough money in retirement. Now, nothing's guaranteed, but you're reducing, by you putting money away today, you're reducing the likelihood of you being broke in retirement. But then on the other side, you have non-retirement money. So a brokerage account, or where you would actually just buy stocks and bonds freely, or however you want to do it. It's creating wealth, or you're kind of living your best life fund, or how I call it. Like, you're going to live your best life. I'm out here. I'm just trying to create wealth in this other account. Retirement, I'm going to be, I have my program, I do this. But on my other side is that, I'm looking at stocks or that I'm interested in, stocks, companies that I have faith in their management. I'm looking at all these things. I'm looking at things that my kids are bothering me about. We'll talk about that a little bit later. And I'm looking at innovation. Like, what do I see on the horizon in the next 10 years? So here's the thing. Like I said, I told you guys I'm a foodie. So your retirement portfolio, your asset allocation depends on your time to retirement. So I'm in my 30s. So I just kind of give myself as an example. So I have to be kind of on the conservative side, I take 100 minus 30s or 30. And so that my retirement allocation is going to be about 70% in stocks. So that's usually in my retirement account. It's usually going to be in index funds, but that's usually where it is. And then on the other side, I have about 30%, and it's a little bit, it's actually, mine is really 80 and 20, but we'll talk about that in a second. But it's about 30% bonds and cash. But I'm a little bit more aggressive. So I have about 80% in stocks and about 20% in bonds and cash. More, it's like 15 in cash and like maybe 5% in bonds. I really don't love bonds, but that's kind of the standard. But as you kind of get older, or I mean, more, I should say, more seasoned in the market, you kind of make some of these decisions to say, hey, I know this is the standard. It's kind of like with the cha-cha. You're like, hey, I had my two-step, and you kind of put your own little thing on it. Like, but you have to get that two-step down to say, you know what, I'm going to deviate a little bit because I feel comfortable in doing this. And I've kind of weighed the risk and benefits of it. So we have the retirement. So I kind of broke it down in a Sunday. Okay. So this is an Oreo Sunday. And so we have our topic. So we have our container. And the reason why I gave it a glass container is because retirement accounts, you don't get taxed, or you don't get taxed unless money comes out of the container. So the container is glass. So, it's I don't say indestructible, but it's a pretty strong container. So, unless your ice cream melts, nothing's going to come out of it. But for the most part, it's going to stay in there. So that's your container. But then with retirement, I have your base ice cream. So we have vanilla ice cream in there. I think, yeah, it's vanilla. We have vanilla ice cream. 95% of your retirement account should be base ice cream. So really standard, kind of run of the mill, really boring portfolio. And then, you have this like little top on the top, you have a little bit of razzle dazzle. So you have your toppings, about 5 to 10% of your portfolio. So, and we'll talk about what that looks like in a second, but that's what I want you to think about when we're looking at retirement. This Sunday looks good, but it's relatively boring. It's, you have cherry, you have some whipped cream, you have some Oreos, got a little sprinkle of Oreos, and then you pretty much have a lot of ice cream in there. And that's what I want your retirement to be. Relatively boring, a little bit of razzle dazzle, nothing crazy. Because again, we're trying to make sure that we're putting ourselves in the best position for a comfortable retirement. So non-retirement. So this is where we get fancy. This is the fancy stuff. We have lots of toppings. We have the sprinkles. We have the nuts. We have the whipped cream. We have the cherry. We have the cookie little crumbles. I think we have a little bit of pineapple, sauce on the side. We have strawberry sauce. We have chocolate sauce. Because when you're non-retirement, you can get a little bit more fancy. Now your container. So let me go to the container first. So the container, as you can see, it's a what is a waffle cone? It's a waffle like bowl. Waffle bones, if you've ever played with the waffle bowl, that thing is about to go. Like either it's going to break, something's going to happen. The ice cream is not going to stay in the waffle bowl, hence the plate. It's just not going to stay there. But that's the same thing with our non-retirement accounts. The IRS is going to send you a form every year if you do a buy let me clarify, if you do a sell in your non-retirement account. They're saying, hey, you have a capital gain or a capital loss. So, hey, you made money. That's called a capital gain. So they're going to say, hi, you owe us money. Thank you. But here's your form to tell us how much you owe us. So that's going to be called a 1099-B. So that's the first thing. And then if you get any dividends from the stocks that you hold, you'll get a 1099 div. And then also if anything else, another thing, you may have an interest one too. So I share those forms to say is that normally with a retirement account, you don't get those forms unless you move money out of your retirement accounts. You will not get a form. There's like when you buy and sell stocks or you get dividends in your account, you're not going to get any documents. But here, look at this flimsy container. This container is going to break at any moment. Same thing with, I don't want to call it breaking, but it's same thing. You'll be getting if you make any moves in your brokerage account, if you do any sales, or if you get dividends, or if you get any interest, you're going to get a form by the IRS. But again, this is, so that's your container. So I just want you to know this container is completely different than a retirement container. So I hope the idea of the glass sundae cup versus the waffle cone kind of gives you that idea that they are very different. And then you have your base ice cream, but see your base ice cream, I can't even see it because there's so much on top, but you get a little bit more freedom and leeway with these non-retirement accounts, or I think you should with your allocation because you have that retirement taken care of. So here, So you're probably going, okay, Courtney, well, yeah, it's a glass container or it's a waffle bowl, but what does that really look like in real life? So you have your employer accounts, you have your retirement account. For your retirement accounts, you have your employer account, which is your 401k, your 403b, your 457, and your TSP. So just to talk about what the 401k is. So 401k is for a profit company. So Walmart, Merrill Lynch, my law firm, we all have 401ks because we're for profit. 403bs are school districts, usually schools, educational institutions, and 501c3s. So I believe the Red Cross has a 403b. My father is a school teacher in the city of Philadelphia. He has a 403b. And then, I also worked for the city of Philadelphia, but I worked for the government. So I had a 457. So 457s are for state and local governments. That is their plan. And the federal plan, which is my favorite plan of all plans, is the TSP, which is a thrift savings plan. So those are your employer accounts. But then you also have individual accounts. So you have your traditional IRA, which is in the traditional IRA, and then you have a Roth IRA. So those are your individual accounts, and then you have your accounts for small business. So if you're a small business owner, or if you even have a side hustle, you are eligible to open a small business account. You have what's available as a SEP IRA. You have a solo 401k, you have a simple IRA or a simple 401k. So definitely if you are a solopreneur or a side hustler, I definitely want you to maximize all your retirement options, but you may want to talk to your CPA to figure out what the best account is for you. And then with your non-retirement container, it's just your brokerage. Really simple, really plain, nothing really special. Those are your containers. So here we go with the basis. So now we're going to start talking about investments. So in retirement, we have index funds. So index funds are mutual funds that basically follow the market. So if you have it, the most common index fund is called is the S&P fund. And we'll actually look at what that looks like in a second. So you have the S&P 500, which is the S&P 500 is the Standard & Poor's 500. It's the top 500 companies that are traded on the stock market. So you have those index funds, but those what's available, they're mutual funds that are available in your employer account. So when I look at my employer account, I'm like, okay, I have a different set of mutual funds that are available. And so I really don't usually there's maybe about 30 or so, and a lot of people get overwhelmed. So I tell when I'm working with students, we look at their listing, but I'm going to tell them to look for their S&P 500 index. I'm going to tell them to look for index in the word, and then let's see what else is on the other side of the index. Sometimes it will say total market index. Sometimes it will say aggregate bond, which we'll talk about in a second. Which is the index fund for fixed income. But I really want people to really look at it and say, hey, I have these options and I don't want to be super fancy. I just want to get the best bang for my buck. So what that means is that a lot of the mutual funds and retirement accounts, they don't tend to be super expensive. And we'll look at some of the fees in a few moments. But they don't tend to be super expensive. But I want you to get the most amount of work for the least amount of pay. So as you get more specific or specified mutual funds, they're going to be a little bit more expensive. So if I'm getting an index fund, what's happening is the person or the company running my index fund, they're just trying to mimic whatever the S&P is doing. That's it. They're not thinking, they're not saying, so basically think of it as a box cake. They're just looking at the box cake, like, okay, it tells me that I need to add water and eggs. I'm going to mix it up. I'm going to put it at 350. I'm going to go about my way. That's the box cake. But on the other side, think about it in another way is that I'm looking, if I'm looking at a baker, we all know when we go to a bakery, I'm going to pay infinitely more in terms of the baker baking my cake than I would index, the box cake. Now, granted, I'm going to expect to get better performance, or better tasting cake, but that may or may not happen. So again, I'm just kind of like super vanilla as I give you my little vanilla, plop of ice cream. We want it to be as plain as possible. But then on the other side with ETFs, so you have ETFs, which are exchange traded funds. They're kind of like mutual funds cousin. I tell people it's like a stock and a mutual fund had a baby and it became an ETF. And we'll talk about what that is in a second. And then we have non-retirement. So that's when we're looking at ETFs again. which is kind of vanilla. But then it's also, we're looking at stocks. Now, it's not that you can't invest in stocks in your retirement account. You may be able to have what's called a self-directed brokerage account. But a lot of people end up kind of, before they end up kind of doing a little bit too much in retirement, that I've seen with when I'm working with people. It's like, okay, well, like, wait, time out. Let's get this as plain as possible. Have a little bit of razzle dazzle, just a little bit. And then, but we have a very, very strong base. That's what I'm looking for in retirement. That's what that allocation should look like in retirement. So, but then on the non-retirement, like I said, you get the whole, but let's go back to that picture. So I think that picture tells you everything. You had the whipped cream, you had the cherries, you have 3 different types of sauces. Then you have some nuts. You also have some sprinkles, and then you have your ice cream. So again, it's a lot more razzle dazzle in that situation, but that's your non-retirement. But when we're looking at stocks, we're looking at companies we know, like, and trust, companies that we understand. And not every company that you like do you purchase or marry. So it's kind of like dating. It's when you're dating someone, when you see someone, you're like, oh, they're a nice person, I'd like to get to know them. Not every nice person that you would like to get to know, you don't date. And not every person that you date do you marry. Usually. Sometimes, some people are lucky that way. But I share that to say kind of the same thing with stocks. So I'm kind of looking at you like, okay, I like what I hear about you, Nike. I want to know a little bit more. I want to kind of look at, what your company has been doing over the last 5 years. And then sometimes, especially now, things that are important to me, I'm like, okay, well, what's your social justice policy? How have you been responding to the things going on in the world? What have you been doing? What have you positively contributed? So those are things that I'm going to be looking at beyond just like, hey, I like your stock price. I like what you're doing. I like your growth. I want to know a little bit more about what you're doing in terms of your contribution to the world. So then you also have like companies that your kids bother you about. Now, I can say very honestly that had my parents invested in Nike years ago when I was bugging them as a kid, they're like, oh, I need Nikes. Oh, I need Nikes. Oh, I need Nikes. Like, had they invested, some of that money into Nike, I probably would just kind of be hanging out somewhere like in Cancun or, I don't know, Joe's Crab Shack, in Jamaica, somewhere, like someplace very, very warm because, I'm in Philly and it's snowing here. But yeah, so again, it's like things that your kids buy, like your kids actually, I love watching and teaching kids to invest because they get really good at it because they kind of take away all of the fluff that we as adults kind of add to it. And they're just like, so for example, I'll talk about GameStop because I know everybody's interested in GameStop. So GameStop, I have a friend of mine who has been shorting GameStop. And we'll talk about what that is in a second. Shorting GameStop for months, probably about a good part of the year. And when you purchase a stock, you're going to go long. So if you think a stock's going to go up, you're going to purchase it and you're going to go long. But if you think a stock's going to go down, you short it. Now, I'm not going to go in the mechanics of shorting, but just so you guys get the idea. So he's been shorting GameStop for years. I mean, maybe about a year. I shouldn't say 4 years, but for about a year before the GameStop debacle happened. Now, here's the thing. What was really interesting about that is that the reason why he was shorting GameStop is because he was teaching kids about the investing in the stock market, and kids were, so he specifically asked, he's like, well, you guys all are gamers, are you guys going to do games? Do you guys want to invest in GameStop? And they're like, no. GameStop's terrible. The way they purchase stock, they purchase games back. They're super cheap. They kind of listed all of the problems with GameStop. And then they also said, why am I going to go to GameStop when I can just buy everything online or with my PS4 or whatever it was? I think it was PS4. So he was like, really? So he looked it up. He's like, you know what? I think this is a good short position. He's done phenomenal with it. So I share that to say, again, like our kids have a really good idea, and it may not be that they understand all the nuts and bolts about stock market investing, but they at least understand the companies. So I like I said, if I told my parents to invest in Nike years ago, like I said, I'd be in Jamaica somewhere because it's cold here. But then also investing in companies that are innovative. Tesla is not on my innovation list. But there are some other electronic vehicle companies that are on my innovation list or that I am interested in because Tesla is an interesting little thing. They just became profitable relatively recently. And I just think that is, as long as they've been rocking and rolling, I'm just like, well, what is going on? What is the problem? So they're not really my favorite. But again, it's about understanding those companies. So you have, a couple, you have Ford. Ford is actually involved in electric vehicles. You have GM. You have a couple of other companies that are involved. So again, there's companies that are innovative. You also have the 5G movement. So some of the companies that, are kind of the long-standing old school companies like AT&T, that may be a company. Then also we have the legalization of marijuana and, whatever you want to do with that. So there's a lot of different ways to go. Okay, so Alice just asked some of the companies that I named. And like I said, I don't want you running out and buying the companies. These are kind of for educational purposes, but always feel free to look at it. But Tesla is a company that I mentioned. I'm not a really big fan of it. Super expensive. I think that company is more reflective of hype than it is actual fundamentals. But then also Ford and GM are involved in the electric companies. And there's a couple other companies that are out there in electric vehicles. Also, companies that are invested in marijuana. There's a lot of marijuana movement going on in the United States, but then also in Canada. So then that's a question of, um, so that's a question of, so that's a question of what are you guys looking at? What do you guys think? And then also it's kind of being a expert, like everybody's an expert in their own thing. And it's also being an expert in what you know. Like my mom's a nurse. So my mom was a retired nurse. She retired in 2016. And there were certain things that she absolutely loved. Like she loved BD needles, absolutely loved them. If they ever, for whatever reason, didn't use BD needles, I heard about when she came home from work. She would call me up. I would ask her about her day, and she would tell me about the needles. But again, that kind of told me that she, one, understood the company and what they had to offer, understood that it was a superior product, so much so that if she had anything other than that, she was annoyed and it messed up her day. So again, is that you, in your own kind of way, you already know kind of what's important or what's kind of popping or what's a really good company. And you also, to the other side, you also know what's not good companies. So I'm trying to think. So I also, for example, I own a Peloton. I've owned a Peloton since 2015. They went public last year. I don't personally buy companies until that IPO, at least 6 months after they IPO. So in about March, when everything started to shut down, I was like, you know what? I was like, I really think this is going to be the move for people now that the gyms are shutting down. And more so that people are probably not going to be comfortable going back to gyms for a while. And so I liked my Peloton. I really loved it. I felt like I was in the gym because I was a spinner in the gym. So I was like, you know what? I think other people will feel that same way. And it worked out really well. Now, also, I think it's a pandemic stock. So it was a company that kind of just was, kind of did really, really well because people thought the same thing. So it kind of popped because of the pandemic. But also, we're on Zoom. We've been on Zoom like all pandemic. So those are the things that I think a lot of people kind of overlook because they're listening to the next big thing that they hear on Squawk Box or CNBC or whatever. But you know more than you think you do. And kind of just a little bit of research will put you in a position to say, like, to do well and investing because you just kind of use what you had in your head, did a little bit of research. So that's kind of why I'm talking about that base. So we have to talk about the base in a retirement account. We have index mutual funds. So a type of mutual fund, index mutual fund is a type of mutual fund with investments constructed to match or track the components of a financial market index. In this case, it's usually the S&P 500. The Dow Jones is usually, there's a ETF that follows the Dow Jones, which is called DIA, like and then you also have the NASDAQ 100. So these are kind of the most watched indexes in the world. So you may want to, consider kind of investing in these types of like broad markets. Like I said, the S&P 500, top 500 companies. Now the Dow Jones is only 30 companies, but the Dow Jones is thought to be an indicator, indicative of the health of the U.S. financial markets, or not even financial markets, the U.S. economy as a whole, like a real-time indicator. It's like one of the most watched indicators. And I've noticed a lot of people come to me like, Courtney, market was up today. And I looked at my account and there wasn't anything going on. And you're like, well, what are you investing in? They'll say, I have a large cap value, or I have this, things that they can't pronounce. I'm like, well, you're not really, you're invested in the stock market, but you're not invested in the indexes that they're talking about on the news, the news. So I gave you guys a copy or kind of a screenshot of the Vanguard by 500 index fund. which is a mutual fund. So if you see with the X on the end, that's telling us it's a mutual fund. I'll show you in a second what a ETF looks like. A mutual fund is not traded on a public exchange. It's actually it's just not traded on the public exchange. They calculate the value of the mutual fund and value of shares at the end of the day, about 8 p.m. at the end of the night. So as you can see, you have the cost per share, and then but a lot of people have this available in their 401ks. Vanguard's is a pretty popular 401k. Popular 401k mutual fund, but there's a lot of mutual funds that kind of look like it. So they'll be like the 500 index fund. I like that because that's where I could put most of my eggs in my basket for my retirement account, because I like it to be super vanilla, super plain, lacking most of razzle dazzle except for that little 5% that I have fun with. So exchange traded fund. So when I talk to people about investing in their IRAs, so it's not something that's connected with their job. They're like, well, what should I invest in? Well, you can invest in a ETF that is also a fund made up of money from many investors, because it's basically a pooled fund that a manager uses to purchase stocks or bonds or other investments to match or track the components of a financial market index. And it trades like a stock. So it's kind of like a mutual fund. Like I said, a mutual fund does not trade on an exchange, and the value is calculated based on all the stocks in the account at the end of the day, minus the fees. And per share, that's where we get that per share cost. But on the other side, you have an ETF, which is a pool of companies, the 500 top companies and the S&P. Okay, so they're all pulled together, but then they're also traded on the stock market. So I can look at any point at my account and say, okay, I can see what's going on during the trading day. So that's kind of the difference between a mutual fund and an ETF. But I like ETFs a little bit more because they tend to be a little bit cheaper than mutual funds. And I'll just see. So then we have our bond funds. So I know that bonds are not the sexiest thing to talk about. They're not the most entertaining. They're pretty dry, but bonds are a pretty good, stable part of a portfolio. So what I've given you is the aggregate bond fund. It's an ETF. And I've also given you kind of I guess it's companion on the mutual fund side. And you can actually invest in either one of those. Let me clarify. You can invest in some kind of aggregate bond fund or some kind of bond index fund, I should say, in your 401k or whatever your retirement account is. But if you have your regular account, if you're doing the investments with a brokerage, or if you're doing you're doing a brokerage account, or if you're doing an IRA or an employee account, you can usually do the ETF. So these are kind of our vanillas. They're not really that interesting. But this is where I wanted to talk about those toppings again. So when you have your toppings are kind of like that razzle dazzle part with your retirement, that kind of top section. Again, you may want to consider using some of your retirement funds. I consider maybe about 5 to 10% of companies that you understand, companies that your kids bother you about, companies that are innovative. Same kind of idea, but we're not kind of putting the whole retirement account in those funds, in those companies. Relatively vanilla. We want to keep it pretty plain. But in non-retirement, you kind of have the same idea. Companies you understand, companies your kids bother you about, companies that are innovative, plus you have options. So options are pretty much, and this is an oversimplification, but it's betting on the stock market. So you think a stock's going to go up, you do a call. You think a stock's going to go down, you do a put. But that's something that you can find you need to be a little bit more educated about. It's kind of a little bit more complicated than that, but it's just like those are your general ideas. But then you also may want to trade in your non-retirement account. But again, any moves that you make in these non-retirement accounts, if you get dividends, if you make any gains and you sell it, it's only if you sell it. The IRS is going to send you a nice 1099, an INT, a B, or a DIV, or what's called a div. So if you get dividends, you'll get a 1099 div. If you get capital gains, 1099B, or a capital loss, 1099B. And then you'll also get an INT or 1099 INT if you have interest income. So here's the thing. So I wanted to give you my portfolio. As you can see, it's I'm pretty I have 80%. I should give you guys the colors. 80% in stocks, and then I also have about 10%, 5 to 10% in bonds, and then I had the rest in cash. And the reason why I have so much in cash is that I want to be able to take advantage of opportunities that kind of pop up. Same thing with my brokerage. I'm not completely invested in cash. And I learned a lesson in about 2000 and I want to say 2017. There was a Brexit. So Brexit happened, I think, in 2016, maybe it's 15. It was one of those years. I think it was 2016 or 15. Brexit happened. So Great Britain said we're leaving the European Union, hence Brexit, Britain's exit. So what happened is the stock market dropped, and I was invested in so many things that I couldn't take advantage of the drops because some of the companies that I was interested in now became in my range or they were on sale. And I was like, because it wasn't related to anything other than people getting panicked about Brexit. So I was like, I missed it, but I was able to, at least with my mom's account, take advantage of it. So she got Apple at $90 a share. She got Amazon like at $900 a share. It was like ridiculous. And you're like, oh my goodness. So you look at these companies now and you're like, wow. But it was just being able to leverage that cash because I was able to take advantage of the opportunities. I always tell people, always have cash in your account because you never want to not have the cash to be able to take advantage of the opportunity. So here's the thing. Here are my general investing rules. I tell people to begin with the end in mind, decide what kind of investor you want to be and seek help. So the biggest thing is about the goals. Like, I want to retire with XYZ amount, $1 million in my account in the next 25 years. Well, what do you have to do to get there? And what I love about retirement accounts is that the tax code helps you get there by saying, well, if you contributed this before taxes, we'll give you we'll deduct it from your taxable income, which ends up helping a lot of people. If they end up making a lot of money, it helps them a lot because it helps with their tax burden. And it's kind of like I'm getting a twofer. I'm getting something today, I'm getting a tax benefit today, but I'm also saving for retirement in the future. So, are there any questions? I think I went through that relatively quickly. But does anybody have any questions about anything that we talked about? Kind of, understanding allocation, also talking about retirement, anything. Okay, don't see any questions. Summer, Brenton, did you guys want to hop on or? Oh,
Sure.
Summer.
Yeah. So thank you again, Courtney, for sharing. We might have one question here. Okay, we have a couple questions coming in. Which company do you suggest to start your portfolio? That's one question. And someone else asked, who do you work for?
Okay, great. Those are good questions. So the companies that I suggest, honestly, I don't suggest any company to invest in to start investing. I really think that you should start with the index. So you have your index mutual fund, which I have here, but then also you have an ETF, which I prefer out of the two of them. You're like, oh, I have both options. I prefer you invest in the ETF, but in the S&P 500, the Dow Jones Industrial Average, the NASDAQ 100. Those are the things that I would kind of start because it's not just one company, it's multiple companies. And that helps you, and that helps build your portfolio. And it also helps build you as a investor because now you're watching those indices and you're hearing what the news is saying. You're like, okay, well, I see how that affected the market. And that's how you you learn investing by education, but then also experience. And that kind of informs your experience, informs your investing as you move forward, as you grow in investing. In terms of who I work for, I work for a small law firm outside of Philadelphia. It's called Kilkenny Law. And I also work for the Ivy Investor. I guess I work for I am the Ivy Investor. I don't know. So I work, I'm the founder and the founder of the Ivy Investor. And I've been doing this for about 7 years.
We have a few more questions here in the chat. One is, do you consider any, well, let's start with the slide you're on now. Somebody would like for you to go over an ETF again.
Sure, definitely. Okay. Oh, I see a lot. Okay.
Yeah.
Okay. So an ETF is a basket of stocks. So in this particular case, it's a basket of all 500 stocks that are traded on the stock market. So I'll pull up. I know Apple's in there. I know Microsoft is in there. So you're getting a piece, you're getting exposure to Apple, you're getting exposure to Microsoft, but you don't own those companies directly. A lot of people like that. And I like it as getting started in investing is because you may not have enough money to buy a share of Microsoft, all 500 companies because they're super expensive, but you're at least able to get exposure to the growth of the company or the performance of the company. So that's what I like about the ETF. But with the ETF, like I said, it's like managing, or I should say, marrying a mutual fund and a stock. So a stock is traded on the stock market, and it's only one company traded on the stock market. So we have Macy's, we have Apple, we have Google, we have Tesla, we have all these companies that are traded every single day from, well, not every single day, Monday through Friday from 9:30 to 4 Eastern Standard Time. That's how they're traded. So that is so that's kind of how that happens with those companies. But you may say, you know what, I really would like to get some exposure to those, but I don't have the money, I don't have time, I can't research all 500. So this is the way to get that opportunity. So what you have here is that you have the price per share at the top, which is 390. So like I said, the market closes at 4 p.m. every single day. There are some after hours trading. As you can see, I have an after hours number. So it's up a little bit after hours. And then you also have what's called the net asset value. So the value of the companies, the 500, all 500 companies that they have investments in, the net asset value, and then they divide it by the number of shares outstanding is $392.37. So it actually is trading at a discount right now. I don't know if a lot of people care about that, but it's trading slightly at a discount. And then also there's a yield there because a lot of the 500 companies, the big companies, they give dividends. So dividends are a distribution of profits and earnings of a company. And it's not necessarily that the company loves its shareholders. It's because if they have excess earnings as considered by the IRS, they get penalized. So companies are like, do we give our money to the IRS or do we give our money to shareholders? And of course, the shareholders are going to win because the shareholders are like, you could have given me money or you're going to give it to the IRS because you got penalized for not giving me money. Oh no. So, so that's what makes the most sense. So that's kind of what the ETF is. And because there's a company that is running the ETF, they're still running the strategy. And it's not necessarily that they're picking stocks, but they actually have to kind of make sure that everything is running properly. There's a cost associated with that. And that's the expense ratio. And that's 0.09%. You don't see that as an investor, but that actually is the cost of that's the cost of how it's running. So it comes out of your investment, but it's not something that you see as clearly as a mutual fund, what's called a load. So I think that was a really good question. So let's take a look. There's a couple of them. Oh, okay. How do you trade your retirement account? So you can trade your retirement account. I don't think it's necessarily the best idea, but some accounts have what's called a self-directed brokerage account. And you may be able to trade directly on the stock market. Companies that are trading on the stock market. However, there's also there's some companies that don't allow that option at all, and you're kind of stuck with the menu of mutual funds that are available in the account. So what brokerage account do I recommend using? That's a really good question, Treaty. So it depends. I don't want people to overthink it. I really like E-Trade, and I've been like, I've worked for Merrill. So I have a Merrill account. So I'm kind of like partial to Merrill, but I also have my retirement accounts for my business at E-Trade. I have a solo 401k and I have a SEP IRA for my business. So I just like E-Trade's interface. I think it's a little bit more easier to work through as just as a consumer. I'm like, oh, this is super easy. And Merrill, I think every so often, even though I'm comfortable with the interface, I'm like, where am I going? So I like, but I'm stuck with Merrill because I like them because I'm partial. But E-Trade, I think, is probably the best for me. But a lot of people like Fidelity, other people like TD Ameritrade. So it's whatever you feel comfortable with. Let's see. So Alice shared that she is retired, or Miss Anderson, excuse me, shared that she's retiring. And how does you start investing in the S&P? Well, you can invest in the Spider S&P, which is SPY, and there's a couple other S&P ETFs that you can invest in also. So let's take a look. I'm just gonna Google. The Spider one is like my default personally. That's not saying that you should buy the Spider ETFs. And I know Vanguard also has a S&P ETF. So I'm going to just take a look. Okay, so there is one that is the S&P 500 from iShares, which is IVV. And then there's also a VOO, which is a Vanguard. And then also, like I shared, that we have the SPY, which is the Spider. So there's a couple that are available to start investing in the S&P 500. And then so Ms. Fraser also asked if Robinhood is a risky brokerage slash app. You know, it is and it isn't. So Robinhood bills itself as the investment app for the people. Like this is just like this is everything, it's for everyone. That's how Robinhood builds itself. And I'm like, well, Robinhood, no, you're not really for everybody. I think Robinhood's more for an intermediate investor. So Robinhood offers kind of I don't want to call it luxury because it's not proper, but they offer kind of more sophisticated trading styles. So they offer options. You have to be approved to do options. And then they offer margin trading. You also have to be approved for margin trading. Margin trading is basically buying stocks on credit. And that's part of the problem that had the whole GameStop debacle going on. So I share that with you to say that typically for you to get a margin account, you have to have $25,000 in cash. Robinhood says, oh, if you have $2,000 and you pay for Robinhood Gold, you can have margin. And you're like, I don't know about that, Robinhood. So that's one thing. But then also options. I like Robinhood's options. I've done options on Robinhood, but I think it's also not for somebody who doesn't understand how options work. And I think it's a little bit too much access without enough education. So I think if you're an intermediate investor and you kind of know what you're doing, I think it's really cool. But I think it's too much, like I said, too much access with not enough education that I think can get people into trouble. So that's a really good question. So I'm just taking a look. Let's see. So Reginald asked what platform do I suggest if you're a beginner. Like I said, E-Trade is a great one. TD Ameritrade has Think or Swim, and that's a good app to kind of get your feet wet, to kind of, you're not in the market, you're a simulated account, but that's a really good way to kind of start getting your feet wet in terms if you want to get if you're a really super beginner, you want to have that kind of simulated experience. But like I said, I love E-Trade. TD Ameritrade is good. So that's what you're looking for. In terms of advanced investor, TradeStation is well liked by a lot of people that I'm friends with. I've used TradeStation. I'm like, I think it's kind of like Robinhood on steroids for somebody who knows what they're doing, if that makes sense. So Marcus asked a really good question. What is the best time of the year to fund your IRA? Well, there's I like to call this time of year like a twofer. So a lot of people, there's not many things that you can do to fix your tax situation from 2020 or the year prior, generally, except make an IRA contribution. So before you file your taxes, or by I think it's the last day, that tax are due, which I believe this year we'll see is April 15th. We'll see what they do this year. Because they said the IRS said they weren't extending the deadline, but I don't believe them, but that's my opinion. But you can contribute your 2020 contribution up until April 15th. And then you can also make your 2021 contributions at the same time. So if you're under the age of 50, you can contribute $12,000 if you're eligible. And I would definitely talk to your CPA, your other tax professionals, such as an enrolled agent, about your eligibility to contribute to these accounts, because there are income limitations. But if you're eligible, you can put them all in the beginning of the year. So I hope that answers your question. So Reginald asked, I think I answered some of that. I really like E-Trade's interface. I like Merrill's research. I'm in love with Merrill's research. And I love they have like little talks with their equities people, or kind of like their specialists. I really just love them. I have always loved them, even when I started loving them when I worked for them, and now I'm hooked on them. So I think they're really good to kind of get a background on what's going on in the world, and I like them. I think Merrill Lynch is a little clunky to me. Even as I've been using it for years, I still feel like when I'm in other other platforms, I'm like, ooh, it's a lot smoother than Merrill's. Let's see, in terms of, and I also know Chase, I mean, you may want to just kind of go wherever your bank is. So you have Bank of America, Merrill Lynch is their investment arm. If you have Chase actually just rolled out a investment platform, I believe either late last year or the year before last. Everything blends together with the pandemic. So that's also an option. So those are things, I think, for the most part, those are the things that I can think of that are the downfalls. I mean, just the fact that the interfaces may not be that great, but I think TD Ameritrade is fine. Fidelity is fine. I don't think there's any of them that I'm like, yeah, I really don't fool with that. I don't really like purchasing stocks on Cash App. I think that's the only one I'm like, I've also started using a program called Public, which is investing for, how do I explain it? It's like Twitter for investing. So it's a lot of people giving their commentary about what they're investing in, what they like, or what their thought process was. So I think that's pretty cool. So Donna, Ms. Harrison asked if it's possible to day trade effectively if you're not available 5 to 6 hours a day. Yes, you can. I definitely suggest that you work with somebody who does have a program and that can teach you. A lot of traders that are not educated lose a lot of money, as we saw with the Robinhood, GameStop, AMC debacle. So I just want people to be very careful. So just education is probably the best way to go. There's a couple of people, Tila Holcomb and Terry Egioma. They're both traders that I've worked with that I trust, that I enjoy. So if you're looking to go that way. So as I shared, I'm a former broker. I stopped working in the industry because I was working for Merrill Lynch. I started working in the industry in 2003 as a financial advisor with it's actually American. It was American Express Financial Advisors, which is now Ameriprise. Then I got a chance to work for Merrill Lynch because I think to me, that was like my dream. So I ended up working in 401k service. And then I went to high net worth advising, where I did what's called separately managed accounts. And I did that until the market crashed in September of 2008. I was laid off in March of 2009. And then that's when I went to law school. So I'm not currently working. And a lot of times we're not able to have these conversations. If I was licensed, I couldn't have as in-depth of a conversation as I would like to, because compliance. I tell people that the stock market, as we learned with Robinhood, the stock market is as regulated as the drug game, or pharmaceuticals, I should say. And then, so indicators to look for when you're looking at a particular stock. That's a really good question. I'll give you guys an example. So a couple of years ago, I was invested in GE. And I invested in GE maybe in like 2006, 2007, like really long time ago. But maybe about 2017, 2018, I was randomly listening to the news. And they said on the news, they were like, yeah, GE is losing money. And one of the things that GE was known for, I should say, was their consistent good dividend. So when I heard that, I was like, that doggone GE, there goes my dividend. And because remember, dividend is a distribution of profits and earnings. But if you're losing money and you're hemorrhaging money, basically based on your operations, you shouldn't have profits and earnings. So then I said, okay. So I expected my dividend to go down after that conversation, after that announcement. Don't you guys know that thing did not go down? And I was like, GE, you guys are on borrowed time. I'm not fooling with you. So what I did as an investor, I said, this doesn't make sense. Your move is not making sense. The fact that but again, they didn't want to change their dividend policy because a lot of pension funds invested in GE. So they knew that as soon as they dropped their dividend, they were done. So they kind of kicked the can down the way. Not the best idea, GE. So I looked at GE and I said, I like y'all. I liked you guys, but we're going to have to part ways. So so I give you that story to say, when you look at a company that starts doing something that they have no business doing, that's outside of their realm, and it probably is something they should not be doing. Like, for example, I'm trying to think of a company that, Let me think. If Chick-fil-A started giving us beef, what I think we will all look at Chick-fil-A like, yeah, Chick-fil-A. You had this whole position on chicken. Your name is Chick-fil-A. Like that's all you do. Now, granted, they do fish for their Christian company. They do fish on during Lent on Fridays during Lent. Okay, that makes sense. That's not a far off movement. But if they start doing beef, you're gonna go, oh baby, what is you doing? Why are we doing this? So that's the kind of stuff that I look for with companies. And I don't watch my portfolio every single day, but I do listen out for the news. I have Google alerts on some of the companies that I'm really watching. And I'm like, okay, what's going on with you? Oh, that doesn't make any sense. I'm going to watch it. And I may not get out of that company immediately, but that company is now in the crosshairs. They got my good eye. So now I'm going to have to look at them. So let's see. So Marcus asks, is there a point where it no longer makes sense to contribute to a retirement account / invest in the stock market? I think that's a really good question. So my mom has been retired for about 5 years. I can't believe it's been that long. She's been retired almost 5 years in June. And she's still investing in the stock market. I think her allocation, and please, this is off the top of my head, I think she's either about 20% in the stock market, and then she has some fixed income. And she also has some cash because she wants to be able to grab her cash out of her retirement account if she needs it. So I think everybody needs to be investing in the stock market even a little bit to just make sure that you're able to keep up with inflation. And also there's plenty of opportunities. Like I purchased Apple for my mom. I purchased some additional Apple for my mom at the beginning of the pandemic. And my mom was like, "Oh, you purchased me Apple?" I said, "I sure did." There's always an opportunity. I think it's about reducing your allocation, but not removing yourself from the stock market. In terms of no longer making sense. Now, on the front end, a lot of people may wonder, well, should I invest in the stock market? I'm like, well, I really want you to have an emergency fund. Before you start investing, I want you to have an emergency fund. That emergency fund can range based on whatever's going on with you. I like about a month or two of expenses that you don't even touch. That you don't even touch, that you don't look at, whatever, but it's there and it's available if you need it. And I mean, especially like with your deductibles on your insurance policies, especially what's going on with Texas, I think that's a reminder to us to say, okay, and that's another thing I want to talk about in a second. It's a reminder of us to make sure at least you have a couple of your deductibles, like your car deductible. If you get an accident, you have a deductible. If you have a homeowner's or a renter's policy issue, you have a deductible. Make sure you have that money available in your emergency fund. But then also just having some extra money, maybe 1 to 2 months. I would prefer 3 to 6, but just to get started, about 1 or 2 months of expenses. So if something happens, like what happened in the pandemic, a lot of people didn't get unemployment for 8 weeks. We're all like, everybody stopped working, but we weren't getting paid. And then all of a sudden we're like, we're not working, I'm not getting paid, but I still have bills coming in. So again, having that cushion, 1 to 2 months kind of at the bare minimum, but I prefer 3 to 6 and even the most at a year. So you just have that cushion, because I think 2020 really showed us how much we need that cushion. So Reginald also asked a really good question about, does my portfolio allocation change depending on your age? Yes. As you get closer to retirement, you should become more conservative. So it's not that you completely remove yourself from the stock market, but you start reducing your position in the stock market and you go to what we call asset preservation, a fixed income that, you have your money and you're getting this interest on it. You're not getting as much growth as you would love to in the stock market, but now we're moving into protection mode. So as you're closer to retirement, so when I was moving my mom closer, I was very aggressive with her because she didn't have anything. But now, I have her about 10 to 20% in the stock market. I don't want her over that much because we still have to preserve what she has. And, if she needs to grab it, if she's all in the stock market, that account fluctuates from day to day. So you definitely want to reduce your position, but you don't want to completely be out of it. So you may be able to invest in your mortgage company. I don't know if U.S. Bank is publicly traded. It may be. I'm not sure. We'll definitely look it up. What I like to do if I'm looking for a company, I'll say, is U.S. Bank publicly traded? I'll put it in Google. Google is very much my friend. I get a lot of answers from Google, some good, some not. But it really is helpful to at least kind of start the conversation and even to see what everybody else is buying. So U.S. Bank is actually U.S. Bank Corp. It is traded on the New York Stock Exchange. and it closed today at $49.06. So you can definitely invest in it. But again, I would probably, it's something, a bank, it's probably a bank you like, but do you understand kind of how they make money? And I would definitely tell you to look at some more articles about it just to kind of make sure that this is something that you really want to invest in. But I think that's a great place to start. Always look at Google's where I start, and then I move from there. So, um, so Marcus, is there a class that I recommend about learning how to trade stock? I do. I recommend Terry Egioma's class, and I also recommend Tila Holcomb's class. Those are two women that I've worked with. I worked with them for the last 3 years. Oh my gosh, worked with them for the last 3 years. I really like them. And then Marcus asked how balance paying down debt versus investing. So a lot of people say there's a school of thought that you pay down all of your debt before you start investing. Yes, Terry Egioma, Frangel shared it. Um, so I'm not a fan of not investing while you're paying down debt. So I do everything by percentages. So if I'm looking to pay down debt, 90% of whatever's I have is going to go to my debt, but 10% is going to go for me. And I think that's a very clear biblical principle, because you're still told, you're still supposed to do things for yourself. I mean, we're supposed to invest. I mean, you have the parable of the sower is like, hey, the parable of the talents, excuse me. You have so many different parables telling us that we have to invest. So you don't want to kind of put everything in something that you did before already, because your debt is something that you did before. You want to actually invest or sow forward. So that's the difference. I mean, so when you kind of, and I mean, the 10% really doesn't make that much of a difference, but it does make a difference when you don't have that much time. And the best thing that you have with investing is your time.
Well, thank you so much, Courtney. This has been, again, another night with a wealth of information. You have brought such expertise to the table, and we really, really do appreciate you spending time with us and just building on our knowledge, like helping us to grow in this area. For all of our participants who are with us, we have one more session in this series next on Tuesday coming up. We're going to have Kevin Matthews of Building Bread. He's going to finish us off with our series. He's a best-selling author and the top 100 financial advisor who has managed over $1 million in assets over the course of his career. He's the founder of Building Bread and has been featured in many publications, most recently a profile in the New York Times. And he's going to be teaching us how to safeguard our new investments. So the learning continues. And so join us back here Tuesday night at 6 p.m. as we wrap up our series. Thank you again, Courtney, for joining us tonight. It has definitely been our pleasure. And thank you for just taking the time to just answer people's questions, because this is definitely an area that I know many people have questions, and it can be scary for some, as it could be new. So again, thank you all for being with us tonight. We're going to close out with prayer, and then we'll move on. Let's pray. Lord, thank you so much for all that you've done for us. Thank you for the wisdom that you've given us this evening. Be with us at wherever we may be. Ask that you would continue to protect us and bring us back together again. In your name I do pray, amen.
Amen.
All right, everyone, you have a great evening, and it was wonderful.